2022's been a very difficult year for the average investor, without any doubt. The S&P 500 is down about 16%, cryptocurrencies have been absolutely a wreck, and the property market's dwindling. And all these price movements have been the result of the same two very big macroeconomic factors over the past 12 months. And you must have heard about them a lot as well. Those factors are inflation and interest rates. Now, during the lockdown periods of 2020 and 2021, the Federal Reserve printed roughly $4 trillion as relief for businesses and citizens. And while it was genuinely relief in the short term, it did have an unfortunate side effect of bringing inflation up to 40-year highs. But inflation left alone only gets worse. So over the period of the past 12 months, the Federal Reserve's had to raise interest rates, which controls demand for goods and services by restricting people's ability to borrow and have free cash to buy stuff. And by restricting that demand, it causes prices to stop inflating. And now the supply and demand are back in line. But long story short, at the end of 2022, we now have inflation at a very high 7.7%. Although it's showing a bit of improvement, and we also have interest rates climbing now up to 3.75 to 4%. So keeping all these factors in mind, in this video, we're going to discuss how we should be thinking about investing in 2023. What are the factors that we need to consider? Now, the first factor that we really need to address before investing is whether you're actually in a financial position to invest this year. Now, while investing is great, there's always this uncertainty that whether your portfolio might go up or it might go down. So to be a really good investor, you need to be in the market for a long time, like 5, 10, or 20 years. That's how people make tons of money in the market. They don't just flip-flop, they make great investments, and they hold on to them. So what this means is, you need to make sure any money you put aside for investing isn't actually necessary in your day-to-day life. You know, if you need that money to pay rent, or pay bills, or pay for any kind of emergency, then you won't have anything in your hand. And the other consideration is this: when interest rates go up, as they are now, companies earn less money and they start to cut costs. Also, now have you noticed that all the biggest companies in the world are doing layoffs? So you also need to ask yourself, do I have an emergency fund? And is my income truly secure over the next year or two? Also keep in mind, while recessions are typically a great entry point for new investors, they certainly aren't kind to workers. So you really need to assess your own financial situation. Then, from there, the second factor to consider is interest rates. As interest rates are going up, there are currently signs that inflation is coming down, and the Federal Reserve may slow the rate of interest rate hikes, but generally this year, it looks as though we're going to be dealing with a high interest rate environment. Certainly a lot higher than what we've seen over the past few years. So what does that mean for investors? Well, actually, it means that in the stock market, high interest rates make it difficult for businesses to grow. You know, servicing debts become more expensive, opening new stores becomes more expensive, and this is also coupled with citizens having less discretionary income to spend on goods and services that make up the revenue of these companies we're looking to invest in. In real estate investing, higher interest rates means higher mortgage repayments. If you have variable rate debts, suddenly returns drop for investors as more of the rental income goes towards paying interest. Then in terms of the housing market, generally it's logical that as rates rise more and more, homeowners will be pushed to breaking points and more homes will come onto the market, which increases the supply, which puts pressure on prices. So there are a lot of issues for property nerds as well. Now, the one asset class that actually does get more enticing with the rise of interest rates is government bonds. As rates get higher and higher, the coupons on new government bonds also rise. But of course, remember, if rates keep rising after you buy a bond, then the value of your bond will go down, and the newly issued bonds with even higher coupons come out. So that's definitely the second consideration you need to make regarding your investing in 2023. You need to be aware of the effective interest rates on your investments. So will interest rates keep going up in 2023? It's a logical question. Unfortunately, no one can tell for sure, because remember, it's all dependent on that inflation rate getting back down to 2 or 3%. Jerome Powell and the Fed have said that they'll keep monetary policy very restrictive until that happens. Now, how long that takes and how many interest rate hikes are required, that's anyone's guess. So that's definitely the second consideration and the third factor we actually need to think about, which may sound contradictory, but it's not. The third consideration is focusing on each individual investment on its merit and not acting based on the macro. So what it means in simple words is that indeed it's important to understand what's happening with inflation and interest rates, but because these things are very unknowable or unpredictable, you should always go back to analyzing each individual investment purely based on its fundamentals. It's like what Peter Lynch said back in his iconic presentation, that no one can predict the stock market, because if they predict correct any of the interest rates 3 times in a row, they'd be a billionaire. Considering there's not that many billionaires on the planet, no one can really predict the economy, right? You need to do good analysis of each individual business based on its fundamentals. You need to ask yourself that you understand the business. Is there a competitive advantage backed up by the numbers, aka uninterrupted growth in revenue, earnings per share, free cash flow equity? Is the management doing a good job? Do they keep debts low? Is the return on investor capital high? And then finally, what's the valuation on the business? And are you able to purchase the shares at a discount to intrinsic value? So the third consideration is to focus on the actual underlying business and not the macro. Now the last consideration, which is going to be important this year, is temperament. You know, the basic gist of the stock market is to buy low and sell high, right? Well, most people actually do the opposite. They buy high and they sell low. It sounds dumb, right? But you know, it's because of this. When the stock market dips suddenly and the news turns gloomy, people panic and they often sell at a loss. And this happens all the time, and it's actually how market crashes occur. So one wave of selling then scares the next wave of people into selling, which scares the next wave of people into selling, and all of a sudden the stock market crashes horribly. But if you want to be a really successful long-term investor, you need to stay in control of your emotions and not act on them. And that's how you succeed as an investor. Now, with inflation, interest rates, and the layoffs happening left, right, and center, it could be another really tough year in the market. We may also get back on track, but you really need to go in prepared for all scenarios. And this gets back to focusing on the long term and only investing money that you don't actually need. There will be very critical components to investing well in 2023. You have to keep your emotions in check after seizure opportunities and stay focused on where you'll be in a decade, not where you'll be in 6 months from now. The stock market could be very volatile next year, and you need to be prepared for that. Now, volatility overall is great for long-term value investments. You just need to train yourself to have the emotional control to not panic, no matter what happens. It's easier said than done, particularly if you're new to investing. But overall, guys, there you have the 4 considerations for investing in 2023. Thank you very much for watching the video. Leave a like on it if you enjoyed it. Also, subscribe to the channel if you're new, and we'll see you guys soon.